Welcome to the deep dive. Today we're getting into something pretty fundamental in DeFi. It's this challenge, right? How do you build something stable, like really stable, on top of collateral that's, well, famously not stable? We're talking Bitcoin, of course.
Yeah, exactly. Bitcoin, the big one. Highly volatile. And people want to use it in DeFi. They want to borrow against it, get stable coins. But nobody wants that liquidation nightmare when the market takes a dive.
That's the classic DeFi problem, isn't it? You want to hold your BTC, hope it goes up, but also use its value now
Yeah.
without, losing it all in a flash crash.
Right. The risk is huge. A 50% drop, maybe more, and suddenly your collateral isn't enough. Forced selling starts. It's ugly.
Which brings us to today's focus. We're going to unpack the BeL2 protocol. The claim is pretty bold. You can mint their stablecoin, BTCD, using your Bitcoin, and there's some kind of protection against liquidation.
You call it crash insurance.
Crash insurance. Okay. So that's the puzzle for us today. How does BeL2 actually do that? How can it hold volatile BTC, back a stablecoin, and somehow guarantee your Bitcoin won't just get wiped out in a big downturn? What is this insurance?
Well, it's not magic, that's for sure. It's actually a clever bit of financial engineering built right into how you borrow the stablecoin in the first place.
Okay, so let's start there. The user journey. I have some Bitcoin. I want to mint BTCD. I deposit my BTC as collateral. What happens next? What's the cost?
Okay, so you'd lock up your BTC. To mint the BTCD against it, you have to pay interest, an annual rate. The protocol sets this rate at 7%.
7% per year. Okay, that sounds fairly standard in DeFi borrowing, maybe a little high depending on the market, but okay. But you're saying this fee, this 7%, is where the magic happens.
That's exactly it. It's not just a general fee. The key is how they allocate that 7%. A specific part of it, 1% out of that 7,
Right.
is immediately sectioned off. It's earmarked purely for risk management.
Ah, okay, so 1 percentage point out of the 7, that's like a dedicated insurance premium baked into the borrowing cost.
Precisely. That 1% is constantly collected and used to buy this insurance we're talking about, protection specifically against those big market drops that could force liquidation.
Got it. So you're paying for protection up front continuously, but what is it buying? It's not like setting money aside in a simple pot, right? You mentioned financial engineering. What's the instrument?
They're buying derivatives,
Yeah,
specifically put options.
put options.
That 1% fee. It goes directly into purchasing Bitcoin put options on a rolling basis.
All right, let's pause there because put option is a term people hear but maybe don't trade daily.
Yeah.
In simple terms, what does having a put option let you do?
It gives the owner the right, importantly, not the obligation, just the right to sell an asset, in this case, Bitcoin, at a specific predetermined price called the strike price. And you can sell it at that price on or before a certain future date, no matter what the actual market price is doing.
So it's like locking in a minimum selling price for your Bitcoin way down the line, even if the market price collapses.
Exactly. It's a downside protection strategy.
Okay, that makes sense conceptually. But why use options? Why not just, demand loads more collateral up front, like 200% or something? Isn't that simpler?
Simpler, maybe, but not as effective in a real crisis.
Right.
Over-collateralization, say requiring $150 worth of BTC for every $100 of BTCD. That works fine for small dips, maybe 10%, 20%.
Right?
But think about the big crashes. We've seen them. BTC dropping 50%, 60%, even more, sometimes really fast.
Yeah, those days are rough.
In those scenarios, that 150% collateral buffer, it can evaporate almost instantly.
Yeah.
Suddenly, your loan is under-collateralized, despite the buffer.
And that's when the standard DeFi protocols hit the panic button.
Precisely. They have to start force liquidating the collateral, selling the BTC at the current, crashed price to cover the loan.
Which just makes the price drop even worse.
Exactly. It fuels the fire. More selling pressure, lower prices, more liquidations triggered. It's a cascade. The user loses their Bitcoin, often at the worst possible price, and the protocol itself might struggle to keep the stablecoin stable. It's a death spiral sometimes.
Okay, so that paints the picture of the problem BeL2 is trying to solve with these put options. Let's make it concrete. The source material had a numerical example, right? Walk us through that.
Yeah, it's helpful. Let's imagine Bitcoin is trading high, say $100,000, just for easy math.
Okay, $100 K BTC.
The protocol, using that steady stream of 1% premiums from all borrowers, buys a put option. Let's say this option expires in 3 months. And the strike price, the price they lock in the right to sell at, is set way lower. Let's use the example's number, $40,000.
Wow, okay. So BTC is at 100K, but they've paid a relatively small fee for the right to sell it at 40K later on. That option isn't worth much unless something terrible happens.
Exactly. It's out of the money, as they say. It's just sitting there, like fire insurance for your house. You hope you never need it.
But then the black swan event happens. The market crashes hard.
Yep. Let's say Bitcoin price plummets,
Yeah.
down past 50K, 40K, all the way down to, say, $30,000, a 70% drop from the top.
Okay, 30-day. In a normal DeFi loan, if I needed like 130% collateral ratio, my $100 K worth of BTC is now only worth $30. I'm way underwater. My collateral will be liquidated instantly. Gone.
Right, forced sale of 30K.
Yeah.
But here, with BeL2, that put option suddenly becomes incredibly valuable. The market price is $30,000, but the protocol holds the right to sell at $40,000.
Ah, so they exercise the option.
Immediately, the smart contract triggers. It effectively sells the BTC at the $40,000 strike price.
Even though the market is screaming $30,000.
Doesn't matter. The contract guarantees 40K. And that difference.
The $10,000 per Bitcoin, 40K strike minus 30K market.
Exactly. That $10,000 profit is generated by the option itself instantly.
And where does that profit go?
This is the crucial part. That profit automatically flows back into the protocol's coffers. It offsets the loss in collateral value caused by the crash. Instead of the protocol needing to sell your BTC at the terrible $30K price to cover the debt.
It uses the profit from the option to shore things up.
What?
To fill the hole in the balance sheet.
Precisely. The option profit acts like a capital injection, perfectly timed for the moment of maximum stress. It keeps the overall collateral pool healthy, even after that massive 70% drop.
So the BTCD stablecoin remains backed, and crucially for the user, their BTC isn't automatically sold off at the bottom. The system absorbed the shock using the pre-funded insurance.
That's the core mechanism. It effectively transfers that catastrophic downside risk away from the user and the protocol onto the seller of the put option, all paid for by that ongoing 1% fee. It's systemic anti-crash insurance.
Okay, that's pretty clever. But this sounds like something a sophisticated hedge fund would do. How does this work in decentralized finance? Who's making these trades? Who decides when to exercise?
Good question. And this is where the DeFi part really matters. There's no human fund manager pulling the trigger.
No.
No. The entire process, collecting the 1% fee, calculating how many options to buy based on the total collateral, actually buying the options, monitoring the price, and then exercising them instantly if the price crashes below the strike, it's all automated.
Automated how?
Through smart contracts. Self-executing code on the blockchain.
Okay, so the rules are set in code, transparent for everyone to see, and they just run.
Exactly. Removes human error, human emotion, delays, and crucially, the need to trust a specific person or company to act correctly in a crisis.
But where does the smart contract buy these options? You can't just call up the Chicago Mercantile Exchange from a smart contract, can you?
No, not directly. That would bring in the old centralized world. The purchases have to happen within the DeFi ecosystem itself.
So on a DX, a decentralized exchange.
Yes. Specifically, a decentralized options exchange. These platforms allow for the trading of options contracts directly on-chain peer-to-peer, governed by smart contracts.
So the whole life cycle stays decentralized. Fee collection, option purchase, exercise, payout, all on-chain via smart contracts and DEXs.
That's the goal. It ensures transparency. You can see the options being bought. You can verify the collateral levels. And it ensures reliability, theoretically. No single party can just decide to halt trading or block the execution when things get rough.
Theoretically. But that brings up a potential weak point, doesn't it? This whole elegant system, this crash insurance, it totally depends on that underlying decentralized options exchange working flawlessly, right? Especially during a major crash.
Absolutely. That's the critical dependency. Imagine that 70% flash crash scenario again. Bitcoin prices plummeting.
Yeah.
So smart contracts need to instantly execute potentially thousands of option contracts on the DA to realize those profits and stabilize the system.
But what if the DX itself gets overwhelmed? We've seen DXs struggle during high volatility. Gas fees spike like crazy, transactions get stuck, maybe the front end goes down.
That's the risk. If the DAX infrastructure can't handle the load precisely when it's needed most, if there's latency, if transactions fail, then the options might not get exercised in time or at the expected price.
And the insurance mechanism could fail, or at least be delayed, which might be just as bad in a fast-moving crisis.
It's a significant infrastructure risk. The security of the BeL2 protocol's promise is directly tied to the robustness and scalability of the underlying DX it relies on for its hedging.
Okay, so that's a really important layer to consider. But stepping back, thinking about the big picture, this BeL2 approach, using options like this, It feels like a step up in sophistication for DeFi risk management.
I think so. It's definitely moving beyond just relying on over-collateralization, which we know has its limits in extreme scenarios. What we're seeing here is the integration of, well, more traditional financial risk management tools, derivatives, directly into the automated logic of a DeFi protocol.
Embedding the hedge right into the system architecture.
Yeah. It's pre-funded by the users themselves through that fee, and it's designed to operate automatically during crises. It signals, perhaps, a maturing of the space where protocols are building in more complex, structured ways to handle the inherent risks of volatile assets.
All right, let's try to summarize the key takeaway here for everyone listening. What's the absolute core of the BL2 mechanism?
Okay, so BL2 aims to let you borrow a stablecoin, BTCD, against your Bitcoin without the constant fear of being liquidated in a crash.
Right.
It does this not just by asking for collateral, but by taking a small, mandatory slice of your borrowing costs, that 1% out of the 7% annual fee, and using it nonstop to buy put options on Bitcoin.
And those put options act like prepaid insurance. If Bitcoin's price crashes dramatically,
The options pay out a profit. That profit is automatically used by the protocol to cover the losses, stabilizing the BTCD stablecoin, and most importantly for you as the user, protecting your Bitcoin collateral from being sold off at fire sale prices.
it's automated, transparent crash protection funded by the borrowing activity itself.
That's the essence of it. And it shows DeFi protocols getting smarter, embedding quite sophisticated financial strategies directly into the code.
It definitely raises the bar, but it also leads to maybe a final thought. Building on that DEX dependency risk we talked about, think about the cost of those options. The price of a put option, the premium you have to pay, isn't fixed, right? It depends heavily on market volatility.
Absolutely. Higher expected volatility means higher option premiums, especially for those out-of-the-money puts designed for crash protection.
So the protocol collects a fixed 1% fee from borrowers to buy this insurance, but the cost of that insurance, the option premium, fluctuates with the market's fear level.
Yeah, that's a potential mismatch.
So the provocative question for you to think about is, can that fixed 1% premium sustainably buy enough downside protection over the long run? What happens if we enter a prolonged period of extremely high Bitcoin volatility? Will 1% still be enough to purchase the necessary options, or would the insurance level effectively decrease just when you need it most?
That's the economic sustainability question, isn't it? Does the fixed premium model hold up under all market conditions? Something to definitely watch.
Indeed. Food for thought. We'll have to leave it there for this deep dive. Thanks for tuning in.